I'm glad to see that a lot of you stayed. You're investors after my own heart because you're interested in a return. Not so sure about everyone who left and isn't too worried about the exit.
That's very important.
It is very important. It was also, I really enjoyed the investor presentation that ended about 15 minutes ago. It's always interesting to hear about startup companies as an asset class. And I think the work that's being done here helps to turn it into an asset class where you identify risks and you structure a deal and you try to help an investor come in and have a little more comfort and certainty that the money they're putting to work is going to be well utilized and that they'll generate a return. That's not the world I've been living in for the last 20 years. And that's because as an M&A specialist, I'm often, not always, but often brought in when things are moving in unexpected directions. So how many of you have been involved in the sale of a business, by the way? Yeah, okay, keep your hands up. How many of you had revenue increase during the sale process? That's impressive. One of you kept your hand up. It's challenging. There are a lot of moving parts, a lot of surprises. What do you think is the primary reason businesses get sold? Any guesses? Yeah? Yeah?
People who sell it doesn't think they can take it any further.
They don't think they can take it any further? That's a good one.
Or maybe their capabilities reach their limits, but the other guys, let's say like Google or Facebook, they have far more of their capabilities to expand it more.
The capabilities of the management?
Yeah, so basically growth.
Yeah? Yeah?
I think it's a win-win situation for both sides. Because for example, the big company hires a team that maybe takes forever for them to grow together. And on the other side, as these gentlemen mentioned, it's on the other side, they need those big resources to grow from that point. So it's a win-win situation. I see it as a win-win situation for both sides.
I like that answer a lot, and those are the deals I love to get involved in, where 1 + 1 = 3. Where your company has built something that's high value, and when you put it together with another set of assets, you get a big win. And obviously that's where you get a strategic valuation. But the number one reason that companies get sold is because of conflict between partners, between founders. It's a pressure cooker. I mean, you wear each other out. And so there are times when the company's doing pretty well, but you're going to have to engineer an exit because you have a team that's just not going to be effective over the long period. But the other reasons are all valid, right? I mean, the deal I'm working on up here in BC, great company. They've executed really well. They've kind of learned on the job. They've grown it up to the teens and millions of revenue. But they feel like they've outgrown the job they created for themselves. They're ready to, in this case, to operate on a bigger stage. And so we're going out to the bigger players in their market saying, hey, these guys have figured something out. They can bring you this business that they've built. But long term, they can run a much bigger division within your company. And that's actually resonating because that kind of talent is scarce. But I guess that's a long-winded way of getting into this dialogue, which is really around, as an investor, as a mentor to the companies you're investing in, and I assume some CEOs in the room as well, what are the things that you need to be thinking about in terms of exit, both planning for it, monitoring the market, anticipating challenges? And I've got a bunch of slides I pulled together for this, but they're largely tactical, right? Because I think strategy is built on 100 tactical decisions. You figure out the next step and the next step and the next step, and then you look back, and strategic is how you describe it when it's done. So we're going to actually get into the weeds a little further into the presentation. But we'll start at a high level. So I've been active in tech M&A for 20 years. I started at Morgan Stanley. I founded TechStrat to focus entirely on middle market software and technology companies. I've got over 100 tombstones behind me. My team has done more. Over $1 billion in wealth created, and really a global focus. So done deals in 25 countries, a few in Canada. And then I've teamed up with people who have mostly been clients, where I've helped them sell a company or companies and they're more in sort of a chairman role or they're industry specialists. So Richard in telematics, he was CEO of Cybit. I've sold 2 companies with him. Andrew just engineered the $1.5 billion recap of Global Logic. He's an expert in services. I sold his business in Ukraine many years ago. Ed is fintech. Ravi is distributed systems and artificial intelligence. And then Alan in mobile. And I'm primarily on the execution side. And I've been an angel investor. I don't do that anymore. I wasn't organized enough about it. When I look, I've had some wins. I had a couple that went to Google. I had one that went to Yahoo. One that went to TNS. But my focus is really more just on the transactional side and stepping into a situation and helping to make good things happen. I also get involved in, just as a commentator on CNBC. In America, if you're on TV, it means you could be president. It's amazing. You're qualified for anything. So that's my credibility. And then a couple of tombstones that I love those pictures of Trudeau doing. I do a lot of yoga, and I love those pictures of him doing is it the peacock where he grabs the edge of a conference table and just the core strength. That's the example that I admire. Anyway, I'm not going to do that here. There's not a table that's strong enough. A few tombstones from deals I've worked on up here, BC and also back in Mississauga, Edmonton. Mostly sellers. Radical game company in Vancouver. We did a deal with Disney. Landworks back in Mississauga. Did a deal with 3Com. That dates that one. And then M-Boot was the second deal with the same team more recently. And then sold Zcom to Enghouse back on the East Coast. That was a New Zealand company. That was about a $35 million transaction. Graphicorp with Corel. Again, that goes way back. Ordovis, Cognos, buying Lex 2000. So every couple of years, I've had one up here, and it's actually just been a pleasure working with companies here because for the most part, you get the advantage of paying salaries in the Canadian dollar and earning revenue in the US dollar, which is, and then some more tombstones I won't go into detail, but over 20 years, and 100 transactions, pretty interesting network. It's always interesting to wake up in the morning and see what's bubbling up over LinkedIn, and I think that's how I ended up here, actually. So let's talk about some of the things that I think about as an investor and also just as an advisor regarding mergers and acquisitions for the companies that you invest in. First is really more about market timing. So what is the market that you're investing into today? What do you think the average age of a software company is when it sells? Any guesses? 14. That's a little bit beyond the 10-year horizon of our presenters earlier. Best laid plans. I mean, a lot of those are founder-owned lifestyle businesses, but 14 years, that's a long time. That also happens to be about the time it takes before a company goes public. Even some of the big, we've had some fast ones like Google, but historically, it takes time. Now, that's a broad data set. I think if you took just the venture-backed companies, you would see a much shorter timeline, but not as short as you would like. So the question is, what is the market that you're investing into, and what is the market that you'll be selling out of? And so we're going to talk about some of the metrics that we look at when we're advising a client on whether it makes sense to do a deal now or wait. And those are the equity markets, public markets, balance sheets. I'll explain that shortly. This is the deal volume, number of transactions, the dollar volume, so the total amount of dollars trading in the M&A market, the active buyers, who's buying? Is it the guys who are going after fire sales and distressed situations, or is it the guys going after premium deals like your example of 1 + 1 = 3? And then we're also going to take a quick look at some of the investment activity in the hot markets that are attracting investment today, and some of the trends around the Series A crunch. So I'll flip through this pretty quickly. This is just more high-level data. I guess the first message is M&A activity moves pretty much in lockstep with the public markets. So this is a 5-year NASDAQ chart. Coming out of the financial crunch, we've seen one major hiccup a year, but we've seen pretty good, steady progress in equity values. And when I look at a screen of public market values today versus 5 years ago, it's pretty impressive. I mentioned Enghouse, your sort of regional ERP company on the East Coast. They're trading at, I think, 4.5 times revenue, which would have been pretty mind-boggling 5, 6 years ago. So equity markets are buoyant. That gives these companies confidence, and it gives them currency to go out and do deals. So that is helping everyone. And you see that reflected in the chart here, which shows the actual M&A activity. And I think the slides are going to be available, at least the data slides. But again, the line is the number of transactions. The bar is the total deal volume. And you saw that, you see that 2016 was a blockbuster year. 2017 is going to be even better, according to the early indications in the first quarter. So again, this means we're in a pretty strong market. And if a client is saying, I might do something now or I might wait for 2 or 3 years, my answer is, why not do something now? Because if we run this chart back a little further and we hit 2010 and we hit 2000, we see some pretty catastrophic events, and it looks like maybe we're overdue. But if you build, you can only give so much credence to the market metrics, because if you build a great company, it's going to have value in any market. The other trend that's critical to be aware of as you're thinking about who should buy your companies is that the private equity groups have actually surpassed the publicly listed companies as net buyers of technology firms. And that includes the public Chinese buyers that are coming in like Tencent and moving up the charts. So what has happened is during the reset in the financial crisis, private equity firms came in and bought a lot of the public companies, the independent software companies, and took them private. And they continue to do that. SunGard, EagleView, big ones. Vista Equity is at $30 billion in capital now. There's almost no one that's out of their reach. And so the green line here is basically the pace of private equity acquirers, and then the top line is the case of the pace of the listed acquirers, and you see them starting to converge. And depending on how you measure, you've already had the private equity surpass the listed companies. So this means that when you're sitting down with one of your companies that you're investing in and talking about who should buy them, there's a pretty good chance that the answer is a company you've never heard of. Maybe they only have 20 or 30 million in revenue, but they have a $7 billion PE fund behind them who are acting as their bankers, and they're out buying companies to build up critical mass. And that's happening all day long, right? And you can't just go to the NASDAQ anymore and run your filter and identify your 10 buyers. You actually have to go to the portfolios and see who owns what and figure out where you fit. And the good news is, historically, the valuations would be significantly lower for those types of transactions. But in a lot of the early deals we're seeing now with the more aggressive PE firms, they're actually paying a reasonable premium. In terms of the markets that are seeing the most activity for M&A, I'm sorry, not the most activity, but the most change. Business-to-business software, media and telecom, definitely on the ascendance. I was talking with someone from Providence Equity. They're about 50 billion, but they've carved off about $1 billion for growth equity. So they're going after companies with 10 to 15 million in revenue. And what he was saying is, in my investment committee meetings, I'm pitching like you would pitch a Hollywood movie. So you would say, it's going to be Jaws, but with snakes on an airplane. And you'd end up with snakes on a plane. And everyone nods their heads and say, I can visualize that. Let's make that movie. But for him, it's CRM for dental offices. Or it's process management for BPOs. It's this for that. It's readily explained. It's clear to people what it does. The market is simple to understand. And that's the pitch that makes sense. And that's the weak point I see in most of the companies that I talk to that are early stage is they haven't really figured that out yet. It can be kind of a grab bag of, we do these 18 things, which one do you like? Or what can we do for you today? But getting down to that narrow pitch and really understanding where you fit and where your value is is critical to telling the story to investors and getting the right investors in there. It's also critical to giving customers comfort that you know what you're doing. And the way that it ties back to this is if that value proposition could be optimized for B2B media and technology or marketing services and technology, which one are you going to pick? Right? It's the one that's on the ascendant. It's the one that's seeing the most activity, that's growing. This is another way, and I tend to, there's no one reliable source in the mid-market where we play, so I tend to, we have our own data, but we also pick and choose from multiple sources. This is 451 Group, looking at which segments are on the rise and which ones are going down. And again, the slides will be available. It's a bit of an eye chart. But a couple of surprises here. One is you saw internet content and e-commerce from 6th place 5 years ago to 3rd place last year. And in Q1 this year, it dropped off the chart. And it was replaced with IT services and BPO. We're seeing a string of high-value deals in that area, a lot of activity. Meanwhile, you see security rising up to the top and staying there. So again, we're pretty focused on software, so this may not be entirely relevant to your portfolios, but it's interesting to see who's up and who's down. And then the last thing I mentioned in the intro was who's buying. Top buyers last year, Google, Salesforce, Accenture, J2 Global. Again, this is in tech. How many of you have heard of J2 Global? I know it's not a software group, but yeah. They've made 80 acquisitions of small technology companies. Their typical deal is 15, 20, 30 million. They've done 80 now. And then this basically shows similar data, but trending over the last, it's an eye chart, but it starts in 2012, and then it goes to year-to-date 2017. So you see Yahoo falling off the map. You see Twitter falling off the map, and their woes are public, so that's no surprise. But you're going to hear a lot more from Google and Microsoft this year, a lot more from Apple, Salesforce, and then Amazon is working on a bunch of stuff, so they're going to be back on the map. And then last point here is on balance sheets. I titled this slide The Offshore Advantage because here we are in Canada. If I'm Microsoft and I've got, I can't remember what the number is, $230 billion? Can that be right? I think that's right. Is that Apple? Okay. Microsoft's just chump change, just 113 billion. So yeah, so if I'm Microsoft and I want to make an acquisition, I could buy Skype in Luxembourg for 8.7 billion and effectively have about a 24% discount because I won't have to repatriate that cash and pay tax on it and then use it for an acquisition. Or I can buy a company in the US. I'm going to do the offshore deal. Cisco a couple years ago announced they weren't doing any more in the US, and they have since then, but it just tells you where the focus is. So the companies we're investing in are relatively small, but the dynamic remains the same, which is effectively if your buyer is operating internationally and they're based in the US and they're aggregating cash internationally, they can buy you with a much lower cost of capital than they could buy a company 100 miles south of here. And then looking at some of the hot markets for investment, internet is back up at the top in terms of inbound capital. Healthcare is number 2, then mobile, and then software, sort of other software. And then we get down in computer hardware, electronics, media, energy, business products and services. But you see the top 3 or 4 really dwarf the rest of them. And then I think this is especially relevant for the group sitting in this room. I get involved in a lot of early exits. And so that's a situation where a company may have only raised $1 million or $2 million or less, but they do something that's relevant to Google or Microsoft, and we get the luxury of skipping the teenage years and basically going from startup to selling to Google to Microsoft. And that option is available to approximately 0.0001% of startups, but it does happen. For everyone else, you've got to figure out how to get through those teen years, which means you probably have to raise a Series A after doing the seed round or the angel round, and then growth equity. And what you see in this blue bar across the center is that middle round, which is gradually getting squeezed down. So you've got the unicorns, which is the bigger bar towards the top, with bigger rounds going into them, raising 50, 100, 150 million. You've got steady, healthy activity in a really early stage, the sort of startup seed stage. But for all of you investing here, this is your risk zone. This is where it's determined whether or not your company is going to survive to fight another day. And we're keeping a close eye on that. It did come back slightly in Q1 2017. We're actually seeing some new funds starting up regionally, but we've seen most of the traditional funds go away. Seattle had Voyager. We still have Madrona. We had Seapoint. We have a bunch that have basically wound up. So that's another area that when I'm thinking as an investor, and like I said, I'm not currently doing that. My wife made me stop. But I'm more involved in real estate, actually, which you could visit, walk across. That's what I worry a lot about, though. Because often the plan says, we're going to lose money through the Series A, but we'll have enough validation to raise the money, and then we'll lose money to the Series B. Well, that option isn't always available. And then finally, this is just a quick synopsis of the most active mid-stage investors. So when the slides are distributed, that'll be available. And finally, IPO, it's funny, it becomes a factor and then it disappears entirely. So 2010 to 2011, it was a non-factor, and then suddenly 2012, we saw a boom, then very little. And then 2016, it just fell off the map. The election, I'm not sure what else. Suddenly, Q1 this year, huge IPO activity. Lots of companies going out, lots of new buyers for my client, optimism. Good things are happening in that world. So I'm going to talk about exit options at different stages of growth, but just to wrap up that market section, as an investor in businesses, often the first meeting that I would have with the team would be to sit down and really focus on what is your exit? Who should buy you? And people who get a lot of coaching coming through Techstars and other venues, they tend to have a pretty glib, convincing sounding answer to that question. But when you dig a little bit, you realize it's pretty theoretical. So the conversation that I encourage people to have, or the topic I encourage them to think about is not only who is your likely buyer, but what is the business relationship that you can establish with them to get to know them, right? So if I'm starting a company here in BC that's making crackers, outside of my world normally, but and you want national distribution, are there companies you could get to know and strike some kind of distribution agreement with where now you've got revenue and you're working directly with your potential buyer? These deals, the strategic deals, tend to happen a lot more often when those relationships are established. And so when I look at the first 5 or 6 board meetings that I'm involved in with these early stage companies, we're looking at 2 things. We're looking at that buyer community, and let's say there's 15 buyers, figure out the 5 we're going to get to know, figure out the approach and the dialogue that gets us in some kind of partnership. And then the second is just pipeline, selling. Yeah.
From your experience, one of the problems...
Got to use the microphone. Sorry.
From your experience, one of the problems which face small companies that, let's say, I'm planning to sell my company to Google, but I'm afraid to go there because their power that they can do what I do.
Yeah.
I normally ask different expertise because each one of them have different point of view in answering this question. So what do you think? Because this is one of the major problem. I'm scared to go to my buyer and say, okay, I can make it.
Yeah. Are you referring to the risk of you talk to Google, they see what you're doing, and now they copy you?
Yes.
Yeah. So I think entrepreneurs vastly overestimate that threat because Google, from a distance, it looks like they've got thousands of people who would just jump on an opportunity and run with it if they figured it out. But the reality inside Google is that everyone is overstretched, and it takes a huge amount of energy and effort to get people focused on a new problem. And so if you've identified the right market and the right problem, and you've figured out a way to bring it to Google so that you're helpful to them, maybe you're going after a shared customer or providing service to their customers, they're going to be receptive, and that risk of them sort of taking your ideas and running with it, they're low. As a friend over at Microsoft Labs put it, I was in there with a startup, and he said, Nat, we've invented more technology and just kept it on the shelf in Microsoft Labs than all of the startups in the world combined have created, right? So their perspective is a little bit different. And the value of the team and the energy of the team actually are huge for them. And actually, during the earlier presentation on the sort of the process of filtering and vetting targets, I wanted to comment quickly on the power of that team. So if I'm a VC sitting in Silicon Valley, I'm going to be thesis driven. I'm going to decide that I want to have a play in container for cloud computing, for example. And once I've made that decision and I have that thesis, then I'm going to go look at the 12 companies that are active in that space, and guess how I'm going to pick which one I'm going to work with? I'm going to pick the best team. And if I'm Google, I'm going to have a similar view on who do I want to work with in these emerging markets. And for the other 11 that I choose not to work with, what am I going to tell them? I'm going to lie. I'm not going to say, your team wasn't as good. I'm going to come up with something else, like the market isn't ready or whatever. Okay, so let's talk now about company timing. So, concept stage. Someone comes to you and says, I've got this great idea. I want to work on it in my garage with some friends, but I'm going to keep my day job, and then maybe in a few months we can start a company. So their goal is to raise money, build value. What is the value of that business? It's an acqui-hire. There's a team that may be qualified to do a job somewhere else, and if someone hires them, they save a recruiting fee. So that's your premium. That's not a very high value stage to sell a company. Now the exceptions are going to be if you've got a superstar that everyone wants and they're locked into that thing, that you can see a valuation move, but otherwise it's tough. So that's an act of really sort of, you have no other choice. Early stage. By the way, I don't have a watch on. Is there?
Yeah, it's 4:15, so you got 45 minutes.
45 minutes? Okay. I should be able to get through half the slides. Early stage, you've got a technology, you're now trying to deploy it with customers, they're using it, you're trying to validate ROI to customers, you're trying to validate the technology, you're trying to really figure out the business model, how it makes money. So there, the acqui-hire value is still there, but now you've got a couple other value enhancers in your business. One is time to market. So now you've actually got a product and a team that's focused on a problem. And if someone comes in and buys your company, they still don't have revenue, they don't have a lot of customers, but they can be in the market a lot faster because you've done that groundwork for them. The only challenge is a lot of that value tends to be expressed as earnout, or potential upside. But I've been involved in 3 deals with Google that happened right at that inflection point, where someone had built something, they had some validation, and Google said, great, this will save us 18 months. Let's grab the team, let's grab the IP, we'll have to redo it at Google scale, but we'll build. So there's potentially value here. But you wouldn't go out and start an M&A process at this stage typically because it really needs to be more inbound. On this time to market question, is everyone clear on what that means? So, okay. Growth stage. So now you've got customers and you're raising more money to grow faster. Maybe you're raising 10, 15, 20 million to grow faster. You're re-architecting the product for scale. You're trying to take that grab bag of value propositions and narrow it down to one that can be captured by a Google AdWord, where someone might actually be searching for what you're providing and they might find you through SEO. You're trying to get reference customers and you're trying to build a viable financial model around your margins to make sure you're building a profitable company. So now you've got the acqui-hire value, time to market, the potential upside through earnout, but you've also got replacement value because you've built something that's real, that you invested at time and effort in building, And you can start to build a DCF because the financial performance of the business is starting to become more clear. Now, there was a question during the earlier session around how do you value a company where there are no comps? And I love that question because we face that frequently. And I guess my first comment is for a really early stage company or for a startup, the comps are pretty theoretical anyway. We don't drive valuation with comps. We sort of abstract comps from deals. Like I'll find out a deal sold for a certain valuation, I'll figure out what the comps are. But it's not like the next guy is going to say, oh, if they paid that much, I'll pay that much. So sometimes it is really replacement value. And this might be as simple as, we invested X dollars in property, plant, and equipment, or we invested Y dollars in R&D. We had 10 engineers for 2 years. So it's really the cost to get where you are today in terms of product. And then you get sort of a bonus for time to market, because if someone wanted to build what you built, it would take them just as long, probably. They can have it today by buying you today. And there was a moment in my life where I felt like I was on the cusp of learning something really important and valuable that very few people in the world knew. And that is how to actually quantify that time to market advantage. Now, I was working on a deal with Microsoft where my client, based up in Edmonton actually, had spent about $9 million building a technology. And I was sitting with Greg Stanger, who was their VP of M&A at the time. And we were going back and forth, and neither of us wanted to go first because I didn't know if they were going to offer 50 or 10, and I didn't have good comps, and he wasn't sure because he didn't know if they were going to ask for 50 or 10. But finally, we got to the point where he went first, and he said, we'll agree with your $9 million. We think we might be able to build it for less, but okay, we'll agree with your $9 million. And we're applying a time to market multiplier of 3x to that. And that was a moment where I thought, oh, good, finally, I'm going to learn the secret. Are they looking at the growth rate of the market and figuring out the value of the white space that they can capture if they're there sooner? Or are they figuring out the customer acquisition cost of taking away customers from competitors if they don't have it right away? How are they doing this? And I waited, and he didn't say. That was sort of the end of his statement. There was nothing more coming. So finally I said, well, Greg, how did you get to 3x? And he said, we want to pay about $27 million. So it was a plug. But there is really no magic formula for that. It's how strategic is it to have it now as opposed to later. And then finally, you do have DCF because you've got revenue and growth. Mezzanine stage, now you're preparing for maybe an IPO, maybe a big recapitalization. That's where the market multiples start to become more relevant. What was the price sales multiple of a competitor when they sold? Or what was the price to earnings ratio? And at that stage, you really are investing in your core IP, but also your systems and infrastructure to be ready to go public. Excuse me. And then we get to exit stage. And now we're pretty comparable to the public markets, the public peers. So where are the competitors trading, and what were the premiums paid for other similar companies that were acquired as public companies? And we can do forward growth and forward earnings analysis. So these are the things that we think about at different stages. And at every stage, there are different metrics and multiples that you can apply. But I think what is often lost in the discussion is the ROI to the shareholders at every stage, right? So if I'm at the concept phase and I've invested $10,000 in some software and a computer to work on something, or I've invested $50,000 to do some testing in a kitchen, and someone wants to buy my idea for $100,000, that's a pretty interesting return just on an ROI basis. It may not be why they're starting the business. They're probably starting the business because they have a bigger vision. But from an ROI standpoint, that's interesting. And then for an early stage company that hasn't raised a big round yet, maybe they've done one of these crowdfunding rounds or they've taken some seed money, and they're starting to get some attention and some traction, and they're thinking, maybe I'm worth more right now to the right buyer. if they're selling for $5 or $10 million on $1 million in capital, that's a pretty interesting ROI. And people will say, oh, you sold out too early, you could have gone bigger, you could have done more. But I actually seldom hear entrepreneurs complaining that they sold too early. You hear it on occasion, but usually it's the opposite. Usually I waited until it was too late. But let's say that you continue to grow and you raise that bigger round, and instead of owning 70 or 60% of the business, your CEO owns 20% of the business. And then they're gradually diluted down to 15%. It's going to take a bigger and bigger event to drive the value, to drive a return to the individual shareholders. And so at every stage, the dilution for me is a bigger factor than the dollars involved. And helping investors and entrepreneurs think through that is really critical. Because at every stage, your odds change too. The number of transactions at over 100 million compared to, I think 90% of transactions globally in M&A are under 100 million, 90%. So you're playing a numbers game a little bit. And that can be expressed, that ROI equation can really be expressed, this is kind of crayon math, but the concept is when you're relatively early but you've figured something out, you've got a product that's working, that's validated, customers are using it, they're generating ROI from it, but you haven't taken that big next round, that big dilution to go sort of build up sales and marketing and go big, that's a pretty high value point to exit. And that can be fleeting. And for a CEO, you might call them to talk about this and they might say, we're just too busy to even think about it. Things are going great, we're growing so fast. Why would we take time out to think about M&A? And that's what I like to call the Superman complex. Because maybe 9 months later, after a couple of flat quarters, they'll call you to say, hey, we're thinking maybe about selling, and you'll say, well, you might have to actually start growing again for that to be a viable option. So 2 points there. One is, at every point before there's significant dilution, you need to think about what kind of ROI you can produce for your shareholders. And the second point is that growth matters a lot in valuation. And I'm going to go into more data around that. But in this graph, after the growth phase, you've got other people coming up behind you who are doing similar things. And you've got competition and you've got price pressure. And now you're going through the battles, trying to figure out who's going to win, who's going to dominate, who's going to emerge on the other side. And whoever does and kind of grows out of that stage and has a defensible market position, they're going to be worth a lot. They can go public. They can do a lot of different things. But not everyone is going to make it through that trough and out the other side. And that's why it's so critical to identify these inflection points in the life cycle of a business and give serious consideration to exit whenever you're facing big dilution and high growth, ideally. Okay, running laps.
From your experience here, what's the average ROI which you yourself see, the best time to sell, and the growth rate at the point which is, as you said, the best time which satisfy the manager and satisfy the buyer at the peak? Because clearly this is the best moment to sell. From your experience in technology, what do you think? How many multiples in ROI and how many multiples in the peak? Because for me as a seller, if I sell at the peak, let's say 5x, now if I can wait to 8x, but the buyer interest will go down.
Yeah. Yeah, and I don't, it's so hard to predict where the markets are going to go, but what I will say is it typically takes 6 months to close a deal. So at a decision point, even if you have inbound interest, at a decision point where you say, yeah, let's give this a shot, you have to be braced. You have to be able to continue to grow in that period, and you have to be in a market that you're confident is going to do well. I've actually got some charts that address some other aspects of that question. Well, here's the first. I talked about growth driving value. What this chart shows, and the trend hasn't changed. Some of the data here is older. The companies are older. Some of these have been acquired, like ExactTarget. But the vertical axis is the revenue multiple. The horizontal axis is the trailing revenue, the 1-year growth rate, year-over-year revenue growth. And so companies that are growing at 5 or 10% are trading at 1 to 2x revenue. At the time Concur was acquired by SAP at 7x, and their trailing growth was 25%, and I think they had a 30% year behind them. You see Salesforce, ExactTarget, Eloqua at 6x with Oracle. So basically, these valuations are moving in lockstep with growth. So that's the first factor I pointed to is equity value in the markets. If you're looking at external timing, if I'm looking at internal timing, this internal growth rate is everything. So there again, if you're invested in a business and the CEO is so busy managing growth that they can't even think about this stuff, that's a good time to take them to lunch and encourage them to think about this stuff. This is how the data is reflected in one of our valuations, working with a company. And so I've redacted this to protect the innocent, but I'll get rid of the eye chart in a moment. What you see here is a peer group of public companies and all of their trading metrics. What is their 3-year growth rate? What is their 1-year growth rate? What is their price to sales, price to EBITDA? And then they're segmented into performance groups. And we look at valuation multiples for each performance group, high, medium, and low. And we're taking our clients and we're slotting them in and saying, well, you're performing like the medium performance group with your growth rate and your margins. What that looks like in summary is my high performance group was growing at 60%, 3-year, 18% 1 year, but losing money, so negative 12% margin. They're trading at 5 times trailing revenue. My low performance group, revenue is shrinking over 3 years or flat over 1 year. 31% profit margin. Awesome. They're making a ton of money. Not awesome. They're only trading at 1.9 times revenue and 7 times EBITDA. So this is what the market values today, growth. If we went back to 2010, when everyone was remembering how to be profitable, it was a different story. But right now, it's really a growth story. Okay, so just to sort of summarize, excuse me, the methods that I've highlighted here. Acquihire, there's a team, they don't really have much yet, but the team has some value, let's go place them. And that's kind of what happens when it's not working out as you would like, but you have a high quality team and they're ready to go make it work at a bigger company. Replacement value, what was the cost of building what they have? And what's the time to market advantage of having it today? Discounted cash flow, what's the present value of all the future cash flows of the business? And then finally, market multiples, enterprise value to sales, to EBITDA, to headcount. And as a M&A advisor, I'm looking to support evaluation on multiple supports. I'm never going to go in with one analysis because the buyer or investor may look at things differently. There may be some other challenges with some of the data where they have maybe better data than us. There's a question in the center of the room. So you want to go in with multiple methodologies and really support the valuation. Yeah.
The previous graph you had the multiple running against growth and revenue, but for other sectors, say like a marketplace where the valuation multiple might be on GMV, how would the growth affect that valuation multiple? Where
the multiple may be based on what?
Gross market value, so like the transaction value of all things in that marketplace.
Like an eBay or a Uber. Yeah. Right now, there's still support for that. There's still support for valuing that kind of business model on the basis of gross market value, as you put it. So that's how Uber can lose $2.8 billion last year and still have an incredible valuation. I think that's sort of the game of kings. So if you're going to go all out and try to build at that scale, you're going to want to have pretty deep pockets because no matter how easy it looks at the outset, it gets pretty expensive over time to maintain that kind of growth. But I think, in a way, it reminds me of the multiples of market that we talked about back in 1999. But there is support for that basis. And so I think what you're raising is an important point, which is for different market segments, there are different multiples that you look at, definitely. The last point I'll make here is that process creates value. Let me explain what I mean by that. If a company approaches one of your companies and says, hey, I want to buy you, and you say, okay, let's make a deal, and then you negotiate a value and you sell the business, you've missed a few critical opportunities. You've missed an opportunity to see if there's someone out there who's willing to pay more. You've missed an opportunity to find out how much more your buyer will pay if they are afraid of losing the deal. And one of my biases after doing this for a long time is that for the really blockbuster valuations, the really interesting ones, it's fear more than greed that's driving that number. I'd love to have this. I like the team. It's a good technology or it's a good company. We'd really like to own it. But it would be terrible if our competitor bought them, because then I'd have to compete against them. Without a process and without going to multiple parties and calibrating the market, you're missing that opportunity. And I think for a lot of first-time CEOs, they worry a lot about offending the company that approaches them, right? They worry a lot about that conversation where they say, I'm flattered that you would like to buy us, but we're going to have to talk to some other suitors as well. We get approached periodically. You may be the best buyer, but we're going to have a process. We're going to have to talk to the others. They don't want to have that conversation because they don't want to offend the CEO, and it feels a little bit like a betrayal. Like, oh, you made the effort to find us and to approach us and to have this conversation, and now what do? We turn around and shop to everyone else. But here's the thing. By definition, the companies that we're involved in have multiple shareholders, multiple investors. The CEO, it's not the CEO's pet project anymore. The CEO is representing the interests of multiple shareholders, and it's their fiduciary duty to go and explore those other options. If they do it clumsily and arrogantly, they're not going to get a deal. But if they do it diligently and they're open and honest with the bidders, with the companies, they're doing their job, they're satisfying their fiduciary duty, and they're making sure that the best possible deals are on the table before they agree to anything. And process can stretch out over 6 or 9 months. It can happen in 48 hours. I'm in a deal right now that's up here in BC. We had a bid deadline of Monday, and we had 6 confirmed companies coming to the table and submitting offers Monday. And on Friday, we had 2 others that had already dropped out come back in and say, hey, we've looked at this again, and it's pretty intriguing. We're pretty interested. And in both cases, I went back and said, well, bids are due Monday. And in both cases, they came back and said, can we have an extension? And they weren't asking for 30 days or 2 months. They were asking for 24 hours. That doesn't mean they're going to close a deal in 24 hours, but that means they're willing to do the work over this weekend and over Monday, do a management call, and get to the point where they can submit a bid with a 24-hour extension, which gives them really kind of 1.5 business days in the weekend. And that is a result of process. If I had called them 6 months ago and said, hey, I want you to make an offer on Tuesday, they would have just laughed and laughed. But if you run a proper process and everyone's educated and up to speed and they've thought about it and they're kind of jockeying for position and they're worried about losing it, but do they care enough? You get down to the wire and really interesting things happen. And that's actually why I still love this work after 20 years, is the people I get to work with, but also just the dynamics of kind of encouraging everyone to step up and show us what they can do under the pressure of a process. The last thing that I'm going to talk about through some, and the details here are maybe less important than the directionally, just the messaging. And I'm saying that because it's obviously impossible to read this slide at all. But the idea is that there's a lot you can do. This goes to process as well. There's a lot you can do to tell the story in a way that's compelling. And the strategic story, the product story, the market opportunity, these are all important. The financial story, if you're far enough along that matters. This company will have flat revenue this year. They're going to grow 2%. Their EBITDA is going to drop by $1 million. So flat revenue, shrinking EBITDA. That doesn't sound very attractive, does it? Well, let's take a closer look. First, we're in their Q3. How are they doing against the forecast? Oh, they exceeded it by 3%. And operating expenses are a little up, but no, still confident we're going to make our forecast of no growth and smaller EBITDA. So the sky isn't falling. We're doing okay. Now, let's actually look at the quality of earnings. Last year, we were mostly selling software maintenance and a few perpetual licenses. I'm sorry, a lot of perpetual licenses and a little software maintenance. So our revenue wasn't very predictable. Maybe we would sell a license and get some money. Maybe we wouldn't. We didn't know. And maybe we would sell some services, or maybe we wouldn't. We didn't know. It was hard to forecast. But if we look at the quality of revenue last year versus this year, what we see is that the recurring revenue has gone up 27%. So suddenly, I'm not so worried about being flat anymore because I'm a better company. I've improved the quality of my earnings to make them predictable. And if I can continue that ramp, I should be at 70 or 80% recurring in about 3 years. And now I've got a business that I can actually finance and take to the bank. So my sort of flat company shrinking revenue story doesn't hurt me as much. And oh, by the way, the reason that EBITDA is down is that we're building a SaaS product. We've been working on it for 2 years. And what you see down below here is the engineering headcount and how it's increased over time and what percentage of that increase is attributable to this new SaaS development. So if I take out that extra $1 million in expense to get our SaaS product launched, which by the way is going to be launched next month, then I have the same EBITDA. In fact, I could be much higher if I wanted to. But with this new product and the recurring revenue, I'm going to be a much more valuable company. And then finally, let's look at the customer base, customer by customer, and validate that, in fact, the recurring revenue per customer is growing. And in the same analysis, we see that the average revenue per customer is growing significantly, and that my churn rate has gone down. So the rate at which I'm losing customers has gone from 18% to 3%. So I'm negotiating value on day one on the back of a flat revenue, shrinking profit hairball. And after running through the analysis and backing it up and having a data-driven discussion, I'm representing a company that has improving quality of earnings, improving recurring, going to a modern SaaS model. Most of the risk is squeezed out of it because they've done the development work. And you should be valuing this like a growing SaaS business. So I wish every story, as you peel back the layers, had this kind of sort of hidden gems in it. But the fact is you can always find things that are going to express your confidence and the value of what you've built. And that's reflected in a valuation that's based not on an EBITDA multiple on shrinking EBITDA, but it's based on multiples of recurring revenue, which is really how SaaS companies are valued. So instead of getting penalized for my flat revenue, I'm ideally going to be up in the $40 to $50 million range. How are we doing for time?
It's 20 to 5.
Okay, so I'm gonna wrap up with 2 points that are Canada specific, because these are pet peeves. I run into them every time I do work up here. The first is, how do foreign buyers view and process and think about and value R&D tax credits? This is where we get in the weeds a little bit. Federal 35%, provincial 10%, cash refundable tax credits that are reported as revenue and as operating income and that boost EBITDA. So that's what the financial statement looks like. To a foreign buyer, they'll look at the company at a high level with just revenue and EBITDA and say, oh, $3 million EBITDA. We'll put a 10x multiple on it. You're worth $30 million. And then they take a closer look and they see the R&D tax credits coming in, and they realize that EBITDA is overstated by $1 million, but the multiple is still the same. Now you're worth $20 million. So as you're getting involved in companies that are doing any kind of experimental R&D and that are generating these tax credits, you need to get ahead of this with your US buyers, because we don't do this. I mean, I've dealt with variants of exactly this in Finland, in France, in Germany, and just about every other developed country in the world. We see it at the state level a little bit in the US, but this is pretty foreign to most US buyers, even the public companies. So you want to get out in front and explain to them how it works. And there's a common misperception for people who do very few deals up here that you lose all the value of the tax credits. And that's not the case either. What you see is the federal going from 35 to 15%, provincial stays the same, and instead of a cash refund, it becomes a tax credit against your next tax period. But it has real value still. And then the second is the value of the exchange rate. I talked to a private equity firm last week who said, hey, we've had 3 Canadian companies approach us in the last 6 months, and all 3 showed a sudden increase in earnings over the last couple of years. And when they went and did the sort of the currency corrected analysis, it turns out a lot of that came from the change in the currency. And the thing is, you can't win with this, right? Because if you took advantage of the currency fluctuation and were more profitable, they're going to say, well, you were just more profitable because of the currency. And if you invested more in growing your business, it's going to be, well, you should have actually been showing a loss, but for the currency. So you want to get in front of this as well and actually show the impact of currency on the operating profile of your business, and then figure out what might sort of balance out those factors, right? So if a lot of the revenue is coming from the US, but there's another weakness in that market that offsets the currency gain, you need to tell a story about this. Just reporting it as being super profitable all of a sudden, like magic, is not going to get you very far. Okay, so I think we have just a short window for Q&A. I see food being brought in and wine, maybe.
We've got 10 minutes.
Okay, good. Any questions?
Questions?
Can you say anything about your business? Sorry, I scared my buddy. Can you say anything about your business model? How do you make money?
I love that question. Thank you for asking it. We're in the business of selling technology companies, and the way that we typically get to know companies for months or years before we engage, and we never charge consulting fees or hourly fees or anything like that. Our sole source of revenue is exclusive M&A engagements, and when we engage, we charge a monthly retainer, and we have a success fee based on a successful exit from the business. And our deliverables in a process look a lot like that. So we're working with our clients through the data room, through building out management presentation, through the financial model, valuation work, figuring out the partner candidates, figuring out the fit. And that's typically a 6-month cycle to exclusivity. I love getting to know earlier stage companies that aren't ready yet, but want to just be talking about it and to be ready. And that's partly self-interest. Good companies get approached, and then suddenly they need help right away. And if they're comfortable with us, and we already are familiar with the model, that's great. So I would encourage anyone here who just wants to discuss companies you're involved in or M&A options in general to there's an open channel.
Just a question about the ROI for different stages of companies. I'm curious about a company, say, like Amazon. Will they come and look at a growth stage company and make an assessment, and if they don't do a deal, will they come and look at that company later, or do they really focus on one segment for their investment, and does that change across companies?
Yeah, there are a couple interesting questions there. So, and Amazon is a little bit of a unique case. Amazon buys dozens of early stage technology companies. Most of them aren't even disclosed. They do a lot of little $3, $5, $10, $15 million acquisitions. And typically those acquisitions result from a very specific need at a specific point in time. They need something, they know of somebody who has it, they make the approach. They're cheap. They don't pay much, but they're serious buyers and they do a lot of these deals. If they don't buy at that moment in time, typically the need passes and they don't ever buy. That's just kind of how their model works and how these sort of fashions float through Amazon. So I'm involved in a couple of things there that involve things they're very hot on right now. And we're trying to grab that momentum because there are executives who are empowered and have budget to go make stuff happen. But we know in 6, 9, 12 months, that moment will be past. They will have already partnered, they will have built, they will have moved on. Other questions?
So if, for example, I come on the negotiation on the price during M&A, is it important that which company buys you? For example, maybe I prefer Apple buys the company than Google. And does that affect the deal? Or is it even something important, or just the numbers?
So we'll distribute slides, but the answer is absolutely it matters a lot. These companies are ranked by revenue growth, top to bottom. Unified Signal, Genesis, Twilio, growing 110%, 107%, 60%, huge valuations. If they are interested in buying you, that doesn't mean they're going to apply their multiple, but it means that you can be accretive at a much higher multiple. So they can pay more, and they're also considering you to be in their peer group. So you're worth more in their eyes. And so this is partly just a popularity contest. You know, if what you have is relevant more to CenturyLink and it doesn't have that sort of new shiny glow on it, then you're going to be down in a different valuation zone. And for it to be accretive, they're going to have to pay rock bottom valuation. Yeah.
Hi. I was just curious what your perception was of the Canadian tech sector relative to the more global landscape, and maybe you can comment on what we're doing okay in and what areas we need to improve on in order to sort of take the competition to the next level.
Yeah, so there have been a few really exciting big companies that have come out, like Cognos and BI, and then there's been a ton of interesting stuff that's happened, especially here around gaming with EA and their big operation, and then all the little spin-out companies that emerged from that. And so I think in order to seed a viable technology sector, you have to have those companies investing and hiring and training people that they can go out and do these things. So here, Mississauga or Toronto, tons going on. Even Victoria now, there's a little bit. And I think some of the HoloLens development for Microsoft happened there in a skunkworks, right, like on the wharf in Victoria. So I think you guys are actually in a really good position. And there's also a culture here of, for the most part, of kind of under-promising and over-delivering. So it reminds me a little bit of working in the Nordics, where like you go to Silicon Valley and someone says, we've invented the best thing ever, but I can't show it to you because the IP is too valuable. And then you go to Finland and they're like, our software is very boring, really, but I guess I must show it to you. And then it's awesome. And you're like, wow, it just blew my mind. There's a little bit of that here, which is exciting. I think the other trend we're seeing is some of the incubators in Seattle. This is a small data point. They're opening here because of the immigration challenges that we're going to face. And that means that if I'm Microsoft, I may put 30 people in an incubator up here or a shared workspace so I don't have to deal with the border. And so you're going to see a growth, I think, in the tech sector over the next couple of years from that as well.
Okay, last call for questions back here.
So my question is related to the question before the last about which company should you try to be bought by, because some companies have a reputation as the place where software goes to die. CA comes to mind. So can you speak to that a little bit? Like, if you know that company is just going to buy you out and kill your software, should you still sell?
I've heard that phrase before, that where software goes to die. I've also heard software Vietnam. So a lot of that sort of low-value harvesting is taking place among legacy software companies that have maintenance revenue but don't really have growth prospects. The fact is, I can usually walk into a company in about 3 minutes, I'll get a sense of where they fit just by culture. So if you're aiming high and you want to make sure that you're acquired by a firm that's going to be exciting to work for and that's going to value what you've built, and the simple fact is the higher the valuation they pay, the more value they put in what you've built and the more probably success you're going to have in that organization, then you just need to pay really close attention to how you build your team and make sure that your team is suitable. When I've done deals with Google, they have interviewed everyone as if they were applying out of the blue for a job. And not everyone passed, right? So if we had 40 people in the company and they did 40 interviews, you might have 7 who are not Google caliber. And that could be a deal killer if those are the key engineers. So that's my advice there. If you're thinking about which peer group you want to belong in, think carefully about who you hire.
All right, any last questions?
You've got it during the cocktail hour.
Okay, we're good. Thank you very much.